Hello, everybody, and welcome you for joining us. I'm Tim Sullivan, president of the Investment Casting Institute. I understand we will have as many as 174 participants joining us on this webinar. The topic for today is an essential charts tutorial. The program features Dr. Ken Mayland, who will be explaining how to read and interpret his essential charts, which are updated and published monthly in the members only area of our website. If you don't have access to the members only area, please see your company's designated representative or contact the ICI for a username and a password. During the webinar, all attendee microphones will be muted. If you have questions that you would like to ask our speaker, please use the Q&A toolbar at the bottom of your screen. We'll do our best to get through all of your questions at the end of today's talk, but as often the case, and particularly with as many as 174 participants, those that go unaddressed will be answered after the fact by an email. So on behalf of the Investment Casting Institute, I'm pleased to introduce Ken Mayland, who many of you have seen at our conferences. Dr. Mayland is president of Clearview Economics. It's a firm specializing in economic research and forecasting. Ken was previously the chief economist of two major financial institutions. He graduated with degrees in economics from MIT and the University of Pennsylvania. He has spent more than 45 years studying the business cycle in order to provide economic analysis to a variety of constituents and close tabs on the economy for his former clients. And those are the essential charts, which we will get the tutorial on today, so we'll know how to read them going forward. So without any further ado, here's Ken.
Thank you, Tim. And thank you all for tuning in. I hope you're all healthy, and I just wish we were meeting under better circumstances. And to all the ICI members that I missed meeting at the late April conference that was canceled because of the COVID-19 situation, I look forward to seeing you next year in New Orleans at your next annual conference. Whether you're a standalone company or a member of a trade association, many of you have been receiving my economic content materials that previously went under the name Essential Charts from Clearview Economics. I dropped my Ohio LLC, so now I just call it the Essential Charts from Dr. Ken. So you may have been receiving these charts for a couple of years. And again, many of you have attended meetings where I presented, and you see what type of data I usually present at meetings, but many of you haven't and have been receiving these essential charts. And they're asking, well, what's this all about? Why am I receiving this data in the form of this economic content? So I thought it would be a good idea to run a tutorial session where I go over both the background for these charts as well as a chart-by-chart review of the information on them, as well as what sorts of insights that they give on the economy. Let me begin first by talking about the origins of these essential charts. Many of you know that I have been a business economist for more than 45 years. As Tim mentioned, I was the chief economist of two banks, one bank in Philadelphia and then subsequently a bank in Cleveland. And then after I left the Cleveland bank, Key Bank, I began a consulting practice that I called Clearview Economics. And I've developed in that practice, that consulting practice, and actively participated in that for 17 years. With that consulting practice, I gave in good years as many as 60 to 80 presentations per year, and I also had a lot of subscription paid for subscription material that I sent out to clients. And so as a result of all this experience, I have my own way of looking at the economy and analyzing the economy, and my own set of pet indicators that I've used to try to understand what's going on in the economy. Well, I mostly retired in the spring of 2017. And as a result of being retired, several of my clients asked for sources that could replace the kind of economic content and the forecast material that I had been providing them. And I did that. I indicated that there are some companies that specialize in economic forecasting. But what you find there is some of the subscription costs for those products could range as high as $18,000 or $20,000 per year. And that's pretty much beyond the abilities of anything but something like a Fortune 500 company to afford. I also provided the people that were interested in continuing to do at least some basic level of economic analysis, the sources of a lot of the raw material that I used in my analysis. But what you find is that while the economic data comes out is very raw, it needs to be massaged or basically displayed in the right way. And it's a tedious process month to month, going after and hunting after the data and recording it and literally making the data speak. So a number of my clients, former clients, came back and asked, Ken, please, can you do something for us? And so out of those requests, I formed what I now title my essential charts for tracking for tracking the economy. Well, what's the basic idea behind the essential charts? Well, there's a lot of raw economic data that you can look at. Every day, various government agencies as well as private organizations produce reams of raw economic data. So there's a lot of things that you can look at. In fact, the database that I buy that helps me do my work has probably over 100,000 individual economic concepts that you can look at on updated monthly basis. But even though I do this economic stuff for a living, I don't have enough time to look at all the economic information is out there. So the idea of the essential charts is to focus on a minimum number of economic concepts that can give you a complete picture of what's going on the economy. And as you've seen with the essential charts, it's totally graphically oriented as opposed to data numbers oriented, because your eye can detect much faster what's going on, what's happening than your brain can looking at a set of numbers. So all my work is graphical. And again, the purpose of the essential charts is to give you at a glance and with a minimum amount of time on the reader's part, give you some really good insights as to what is going on in the economy at any point in time, as well as giving you some insights into the prospects for where the economy is going, because a number of these economic concepts by their nature are leading indicators. And so they lead economic activity. So that leading nature tells you and gives you some insight into where the economy is going. And then from that, the point is to create a discipline of reviewing that material on a monthly basis. And when you do that, and you understand what the charts are telling you, you can literally see business cycles unfold. And you can understand by looking at those charts where you are in the business cycle prospect. Now I'm going to switch my screens here and bring up the essential charts that you do see on a monthly basis. Let me press a button here. And there you go. This is my header material, essential charts, chart deck for tracking business conditions. So let's go over these charts one by one and try to understand what they're telling us. And this first chart is my summary, big picture macroeconomic overview. So at a glance, we look at gross domestic product. That's the economy. That's all the goods and services produced by the economy and bought within an economy. And I have industrial production, which of course is the industrial side of the economy. It's not just manufacturing, but it's manufacturing, utilities, and mining. They all combine for the industrial side of the economy. And you'll see in the legend here that I show a year-over-year change of real GDP, and I show a year-over-year change of the industrial production index. So I look at these on a year-over-year basis, and the reason for that is that on a quarter-to-quarter basis, well, industrial production is monthly, but we average it to quarters. Even on a quarterly basis, there's a lot of noise. There's a lot of volatility in these measures. So by looking at it on a year-over-year basis, what you're doing is you're zeroing out a lot of the noise and focusing on fundamental trends. And as I said before, aside from looking at individual numbers, what the individual percents are at any point in time, what your eye can see very quickly, you can see trends being determined. You know, for instance, this period from 2017 through towards the end of 2018, you see a rising trend of GDP growth. In other words, the momentum of the economy was increasing, and with a little more volatility, but likewise, you can see the trend of industrial production the trend growth of industrial production was rising. Then towards the late 2018, the trends then changed. You see from late 2018, you see a falling trend for GDP growth. And because industrial production is more volatile than the economy as a whole, you see a faster declining trend in the growth of industrial production. And in fact, towards late 2019, the year-over-year growth of industrial production was negative. So again, the point here is this is a really big picture view of the economy and the basic trends of the overall economy and the industrial sector. You can look at this picture and very quickly, with almost a blink of the eye, not even knowing what the individual numbers are, you can see which way the economy is trending. Now, let me add another point here in this chart and in some of the subsequent charts. It's obvious that with the evolution of the pandemic and its grip on our population and on our economy, things transpired very fast in the economy in an unprecedented way in the economy. And so, for instance, going from the first quarter into the second quarter, or actually, this is through April, you see this very sharp drop off of industrial production growth. This is because what happened in March and April. Now, I mean, it's the nature of these software programs that produce the chart is whatever the range of data is, they will fix the scale so that all the data fits in. And so if you have very, very drastic changes from kind of peak growth to negative growth, then the smaller changes, the little more subtle changes kind of get minimized. Not that you can't see it, but it maybe just a little bit harder for the eye to detect. And again, we've had such rapid changes in the state of the economy as a result of the pandemic that there's going to, because of the scaling effect, you're going to see some distortions in how these charts look, and that's going to become painfully evident in the this next chart, which shows weekly initial claims for unemployment compensation. I say in my little description here, this is probably the best macroeconomic indicator and leading economic indicator that you can follow. I've said sometimes in my presentations, if you're going to just follow one economic indicator, this one is probably the best one to follow because it has just such a long history of anticipating changes in the economy. Initial claims for unemployment compensation are basically insured company layoffs. And so when layoffs are rising, that's obviously a bad thing for the economy. And when they begin falling, that's a good thing for the economy. And as you look from economic cycle to cycle, these weekly initial claims have given leading indication that, in other words, they rise in advance of the onset of recessions, and they begin falling before the end of recessions. Another advantage of these initial claims for unemployment compensation is that this is one of the few economic data series that comes out weekly. These numbers come out every Thursday morning at 8:30 in the morning, released by the U.S. Department of Labor. So if you're really interested, every week you can get a fresh reading on the economy. Now, this distortion of the scale is most evident in these numbers. Perhaps your eye can detect from 2017 through 2018, there was a tiny reduction in the weekly initial claims for unemployment compensation. And so we got to the end of last year, let's say this point, beginning of 2020, they fell to the lowest level in history. They were so extremely low, which was an indication that the economy was really doing well. Then with the March numbers and now the April numbers, you can see them blowing up. The numbers represented here are the average of the weekly numbers. There's 4 weeks per month. And so for March, the average of the weekly numbers was 3 million new claims for unemployment compensation per week. So multiply that by 4. So there was 12 million new claims in March. And looks like here we have about 4.5 million, 4.5, 9, that's 8. And you had an additional 18 million new claims for the month of April. So you combine these two, and that's how you get to figures that show the last 7 weeks. If you just accumulate the last 7 weeks, you see that there was something like a total of 33.5 million filings for unemployment insurance. But in more normal times, you want to look for trends. Declining trend of weekly initial claims is good. A rising trend is bad, and it gives you some leading indication of where the economy is going. The best single macroeconomic indicator. Now, a second indicator that I value extremely highly, and as far as I know, I'm the only business economist that puts so much weight on these numbers, are a tally of the year-over-year growth of total business sales versus the year-over-year growth of total business inventory. So these are all in 12-month percent changes. And the old way of looking at business inventories for companies and for an economy was an inventory to sales ratio. But the technologies that have evolved for managing inventories over the past couple of decades has rendered a simple inventory to sales ratio is pretty useless. Technology allows for lower and lower level of inventories for any level of sales. But that does not, even though that's the case, that doesn't mean that there is still some cyclical dynamics to the growth of inventories over time and the declining growth of inventories growth over time, as well as growth of business sales and the deceleration of business sales. Now, here's the key fact. when business sales growth, which I represent here as the blue line, is faster than the growth of business inventories, sales growth greater than inventory growth, that's a good thing for an economy. If your sales, if you're a retailer or if you're a producer, if your sales are growing faster than your inventories, that sends you a message: order more, so you can sell more. And if you don't, if sales keep on outstripping inventory growth, they'll be literally at some point way down the road, will you run out of inventories, because that situation can't persist forever. So that's a good thing. The flip side of that is there will be cyclical periods of time. It's not random. It goes in runs of many months when you see that sales growth drops below inventory growth. That's a bad thing. So you seeing your inventories pile up in the back faster than the sales are going out the front door, that also sends you the signal: slow your ordering. Or if you're a manufacturer, slow your production. So this is a key driver of the business cycle. Now I want to show you. See, here's 2017 through about 3/4 or so of 2018, sales growth greater than inventory growth. Go back to that first chart on GDP growth and industrial production growth. When sales growth were greater than inventory growth, you saw an acceleration of GDP growth. You saw an acceleration of industrial production growth. Now look back at this period, late 2018 through almost all of 2019, sales growth less than inventory growth. Okay, what did the economy actually do during that period of time? Well, you saw the economy as a whole decelerating growth, and you saw industrial production, which again is more volatile than the overall economy. You saw a faster deceleration of industrial production growth. In fact, actually industrial production growth dipped into negative territory. So this is a key driver for the business cycle, and there is a great deal of insight that you can derive by following this data on an ongoing basis. So these are my two favorite business cycle indicators. Now let me talk for just a minute about business cycles and what are the drivers of a business cycle. Here, obviously, we have a major one, and what are the causes of recessions? Recessions, apart from exogenous factors like pandemics or wars, those are exogenous factors that are just beyond the scope of economics and economic forecasting. Political events, health events, but they're not economics. They're not primarily an economic event. But the main causes of recessions are due to economic excesses. And the excesses can take three major forms. You can have inventory excesses. So, for instance, here you have an inventory excess. Inventory is growing faster than total business sales. So you can have inventory excess, one cause or driver. You can have credit excesses for one reason or another. Too much credit gets pushed into an economy, and almost for one reason or another, and almost inevitable with that, you get too much bad credit. Too much credit goes to perhaps people and companies that shouldn't get credit. So the ultimate outcome of too much credit is defaults and bankruptcies, which then cause a reaction in the banking system of them curtailing credit in order to stem their credit losses. So that's the second driver. And then a third driver of recessions is, or in excess, is too much inflation. And inflation is bad once it gets beyond a certain point, because the Federal Reserve is duty bound to resist an accelerating inflation rate when inflation gets too high. Right now, the Fed defines 2% inflation as about right. And then when you get much beyond that, that's when the Fed will begin to respond to it. And they respond by tightening money and credit conditions. They raise interest rates. And that policy is specifically designed to slow down the economy, because that's the way you beat back an inflation problem. You slow down demands, and so you get a better balance between demand and supply, and so the supply can become more in better balance. But we've seen in past business cycles, sometimes the Fed goes too far, they overstay a tight policy too long, and so you just don't slow down an economy, you really bring down an economy. So those are some basic causes of recessions, and each of these causes, I have some data in this whole essential chart deck that addresses each of those aspects. So as I said before, the inventory excess problem or potential problem is reflected in this chart 3. But let me go on and look at a couple of several of these other indicators. I chart here in this fourth chart what I call leading edge sectors: housing starts and light vehicle sales. Traditionally, again, if you just look at the past history of business cycles, you tend to find that housing starts are a long leading indicator. Their advanced warning that they give to the economy for recession, as well as some insights as to when the economy's beginning to improve, is maybe on the order of, well, going into recessions 9 to 12 months. Coming out of recessions, it's shorter, maybe a couple of months. But that's a long lead economic behavior. And then I chart auto sales here, which again, if you look at the history of business cycles, what you find is that they give some advanced lead time of perhaps somewhere around a half a year, 4 or 6 months, something like that. So that's why these are two major sectors of the economy, housing and auto sectors. They are leading edge sectors. So there is a good deal of insight you can be gained by following these indicators. Here again, we have the scale distorted by the sharp drop of auto sales that went from January, February through March and April. You see, I think your eye can still see a slight downward trend in auto sales as we went from 2017, 18, and 19. Ooh, slight downward trend. My own view was that after years of 17 plus million units of auto sales, that auto sales were kind of getting tired, and I was, in fact, expecting some minor drop of auto sales. And my hope was that they would hold to maybe a 16 million unit level. Well, by the way, you see with the data, they dropped to about a 9 million unit level here. This is on an annualized basis. And by the way, 9 million units was about as low as auto sales went in the Great Recession, late 2007 through mid 2009. They dropped to, over the course of that recession, to about a 9 million unit level of sales. The bars here show housing starts, monthly housing starts on an annualized basis. For a number of years, we were kind of cruising along at somewhere around 1.2 million units of annualized housing activity, maybe a hair higher. The pity here is that as 2019 came to a close, and with some drop of interest rates, mortgage rates, you saw housing activity picking up. We went from 1.2, 1.3 up to 1.5, 1.6. The pity here, this was a leading indication that there was a good chance that the US economy, in the absence of the pandemic, was going to be in the process of reaccelerating. And let me go back a chart here. You'll see in this sales growth versus inventory growth too, that at the end of 2019, you saw the declining growth of business sales come to a stop. It rebounded. Inventory growth kept slowing. So you just around the turn of the year, you got this flip in the inventory situation. What had been negative just turned positive in very early 2020. And that too would have set the stage for some reacceleration of the economy in 2020. And so that's the pity of this current situation. Let me go on to another indicator, which I entitled the slope of the yield curve. Slope of the yield curve is at any one point in time, the difference between a 10-year Treasury bond and a 3-month Treasury bill, the difference in those interest rates. On average, that slope is positive, or that difference is positive. And a positive yield curve is typically interpreted to be positive for the economy. So monetary policy is accommodative, a good thing for the economy. But over time, that slope of the yield curve diminished, and in fact, in mid or third quarter of 2019, that slope went negative. Negative means the 3-month Treasury bill rate rose above the 10-year bond yield. And that's a negatively sloped yield curve. And the interpretation of that is that monetary policy had turned less accommodative or even restrictive. And that was, a negatively sloped yield curve has been associated with most of the recent recessions in past business cycle history. Yield curves turned negative and a recession followed. I don't think that would have been the case this time had it not been for the pandemic and the economic impacts of the pandemic. But it might have been a close call. Again, you go back as that slope was becoming less. You see that industrial production growth was decelerating, and in fact, at the end of 2019, went negative. So I hope you see how a lot of these economic indicators are kind of coming together. They supplement each other and reinforce each other. But now that slope of the yield curve is positive, and positive is a good thing. Monetary policy is accommodative, and over time, this is judged to be a leading indicator. That should be a plus for the reinstitution of economic growth or accelerating economic growth. Let me go on to a couple of more charts here, what I call eyeball econometrics. And what I show here is two major aspects of the economy reflecting consumer demands, and the consumer spending is the biggest single sector of the economy. It's roughly 60% or so of the economy, maybe 2/3 of the economy. So activity there is important to the overall economic situation. Then I have industrial production in manufacturing. And what I mean by eyeball economics, you just plot out the monthly numbers as they are released by let's see, I think Census Bureau reports retail sales. Industrial production is reported by the Federal Reserve. You just simply plot these out over time, monthly, and you just see your eyeball. Again, regardless of what the number is or what the latest monthly percent change is, you just plot the levels, and your eyeball will detect those trends very quickly. We were on a rising trend of retail sales until until March and April. Industrial production, again, more volatile. We were on a rising trend through late 2018. Declining trend there, fits in with the inventory situation and the yield curve situation. Decline trend there, and then the bottom falls out in March and April. But the whole point here is just at a glance, your eye can detect the trend of these two major aspects of the economy. I mean, that's the point, to just visualize easily what's happening to these two major aspects of the economy. I have a couple of more credit risk-oriented indicators shown in these two charts. The TED spread, the so-called TED spread, is the difference between the 3-month LIBOR rate, which is kind of like a CD rate, bank CD rate, but it's a CD in a foreign country, on a dollar basis, versus the 3-month Treasury rate. So the 3-month LIBOR rate has some element of credit risk, and presumably a 3-month Treasury bill representing the full faith and credit of the US government has no credit risk. So looking at the two gives you some market assessment of what market assessment of the risk is. And you see how these numbers evolve over time. This other measure of credit risk shows the difference between a double B plus, which is the highest rated junk bond. Triple B is the end of investment grade. Then you go to double B plus is the highest grade junk bond versus a 10-year Treasury bond. And again, that's presumably credit risk free. There's no credit risk. So this gives you a measure of credit risk in the bond market. And why we have these measures of credit risk, either short-term, in the short-term markets and long-term markets, is what we found over the years is the bond market has been particularly successful, particularly sensitive in sniffing out problems with the economy. If the bond market starts sniffing out problems in the economy, they start moving the spread. It opens up the spread between lesser rated bonds and a risk-free bond. And so, as we see here, March and April, those credit risk spreads just widened out very fast and widened out enormously, indicating the market sees major risks here. And then that causes people to do things in the economy that can lead to deteriorating economic conditions. I show in the next two charts some momentum measures on the economy, looking at the momentum of job growth and the momentum of industrial production growth. Here again, this would look a lot better if it wasn't for the scaling problem. I look at the 4-month % change of job growth versus a 12-month change in job growth. If the 4-month change is higher than the 12-month change, that's a good thing, and probably that's leads you to suspect that the economy is accelerating in the job market, and the same thing is true in the industrial side of the economy. If the 4-month change annualized is greater than the 12-month change, that's a good thing. If the 4-month change drops below the 12-month change, that's a bad thing, or it's indication that there's some deceleration in the industrial side of the economy. So we're looking at kind of short-term momentum versus long-term momentum, and to give us some insights into kind of which way are the trends likely to go in the future. I have some charts on prices and inflation included here. Commodity prices in general, and the price of copper in particular, is these prices are very sensitive to demand conditions. So if demands are strong, these prices are rising. It's reflective of an economy performing well, probably seeing accelerating growth. If you see these prices fall off, that's suggesting that demands are coming up short of supply, so that's why the prices are falling. That's a bad thing for the economy. So this is, again, reflection of kind of the trends in the growth of the economy. In fact, copper prices are so good and so sensitive. Some people call it Dr. Copper, the only commodity with a PhD in economics. That's a side, but that's why a lot of people watch copper prices in viewing overall economic conditions. By the way, these copper prices now have pretty much stabilized. As weak as the economy is, they've pretty much stabilized at about this level, which is kind of a good thing. If they continue to decline, I mean, this is something you can watch on a daily basis, or you can even watch this on a by-minute basis during trading hours. You can watch these, but these prices have stabilized, and that's probably a good thing. Show inflation trend here. Show an inflation index for overall consumption goods, and I show it ex food and energy. This is not quite exactly the same as the consumer price index. It's very similar, but there's some technical differences between the PCE, personal consumption expenditure prices, and the consumer prices. There are technical reasons why this could be a little bit better, give you a better indication of inflation. But basically, you want to know is inflation. If the Fed says the goal is 2% inflation, if you're below 2% inflation, then fine, no reason for the Fed to worry. If inflation rises above 2%, well, then the Fed may begin to worry. And in fact, what did the Fed do when these numbers rose above 2%? The Fed began to raise interest rates. And when the subsequent inflation rate started to trend down and drop below 2%, what did the Fed do? The Fed lowered interest rates. So you get some sense of which way monetary policy should be going, a more accommodative, less accommodative, or restrictive based on this view of inflation. I show for kind of the record foreign exchange rates, because that's kind of important for, in particular, the manufacturing sector and interest rates here. Foreign exchange rates, it determines the pricing of our goods versus other goods produced by other producers in the world. The point here is that foreign exchange rates have a long tail in terms of their influence on the economy. That tail, that impact on the flow of goods, the subsequent flow of goods, can stretch out over the course of 3 years. It's not immediate. It takes a little time for it to begin to be felt, and you feel that impact unfold over a 3-year period. So the low that the dollar reached here in beginning of 2018, if that was sustained, you would have 3 years of kind of strong export demands associated with this. But these exchange rates are very volatile, they change fast. So some of this rise of the dollar has now offset the good impact of a low dollar on trade flows that we saw in early 2018. And now the dollar is very strong, and that, if nothing changes from here, that's probably going to have a retarding effect on our exports over the coming 3 years. I show interest rates here to reflect both economic conditions in general and the stance of monetary policy. If you're a company, you probably don't like to pay higher interest rates, but the fact is rising interest rates is a reflection of an economy doing well. Falling interest rates are a reflection of an economy doing less well, or ultimately badly. Rising interest rates tends to mean the Fed is maybe beginning to make monetary policy less accommodative, which will have at some point a retarding effect on the economy. Falling interest rates, in fact, very low interest rates. The Federal Reserve is very, very accommodative to the economy now, and over time, that will be a positive thing for the economy. You see, as a result of this fall of interest rates, mortgage rates reflected also the fall of the 10-year Treasury. So what we see towards the end of 2019, beginning of 2020, you saw housing starts pick up. So this gives you some insights to, again, basic flow of the economy as well as monetary policy. Final chart I show here is a chart of the stock market. Who doesn't like to see something on the stock market? And it is a fact that many of the recipients of these essential charts, they're not manufacturers, but they're asset managers trading in stocks and bonds. So they like to see something reflecting the stock market here. Basically, the idea here is you look at the latest month's end of the S&P 500 versus a 10-month moving average of those month's ends. And what you find historically is that bull markets tend to last a long period of time, and you see this tendency for the latest month, whatever there's a lot of month-to-month fluctuations, but what you tend to see is for extended periods of time, the 1 month latest measure of the S&P 500 index is greater than the 10-month moving average. And that kind of gives you confirmation that a bull market is in place. But then you also see some extended period of times where that latest month falls below the 10-month average, and that persists. When that happens, that tends to persist for periods of time, and so that defines bear markets, and you're going to tend to let bear markets run till they run out. That's when the 1 month rises above the 10-month average, and then ride the bull markets. I mean, you get some 1 month variances in here, so you probably want to, if you're trading on this, you want to see 2 or 3 months of the monthlies below the 10-month average. But anyway, there you have it. Those are all my charts. In summary, I have 16 charts here that they work together. There's some redundancy that they give you insights, but they really supplement each other, and just by following 16 charts, so you can look at this material, just eyeball this material on a monthly basis. Probably takes 5 minutes to 10 minutes to just flip through the charts, and just with your eye, you can very quickly see what the economy is doing and where it is going. So I'm going to go back to, if I can figure out how to go back to my big picture there. There we are. And I probably waxed a little bit longer than I should have, but I'll take as many questions as long as you want to hold this forum open. So if there are questions out there, I'd be happy to try to answer them. Erin, can I turn it back to you for directing traffic here?
Yes, this is Erin from the ICI. We do have a couple questions, Ken. It says, there are many opinions regarding the shape of the recovery. Yep. U, V, swoosh, Z, W, etc. What is your opinion?
I've taken the position, and again, my monthly set of essential charts comes out with a email that has a little economic commentary in it. I don't do forecasts in my economic commentary per se, because I get paid for my forecasts, but I do try to focus on some kind of economic issue that I find interesting, and so I've covered a lot of different topics in these the email, the body of the emails. I've taken the position that I'm saying it's going to be a V-shaped recovery, but you got to understand what I mean by that. V-shaped to me means you get a very sharp drop in economic activity, which obviously we've seen. Do not be surprised to see when the second quarter GDP numbers come out, you're going to see something like minus 40%. Don't be shocked. This is just the arithmetic. I mean, we send people home, shut businesses down. The number is going to be just absolutely stunning. So that's one side of the V. Now, when I say a V-shaped recovery, I don't mean, I absolutely do not mean we will recover that fast. What I mean by V-shaped recovery is that you will see quarters of what in ordinary times would be extraordinary growth. Now, keep in mind that the average growth of the U.S. economy annually in inflation-adjusted terms has been 2-3% per year. On the high side for a year or two, here a year or two, it's been 3%. On the low side, it's been 2%. So that's the normal range. What I'm saying is that you're going to see some quarters of 5%, 8%, double-digit growth in real GDP, and it's because of that higher than what, in fact, significantly higher than normal growth. That to me gives what I think the recovery a V shape. But let me also say, even when you see, like, let's say the economy rebounds 4 or 5% in the third quarter, 10 or 15% in the fourth quarter. I've done some simulations in my own modeling material. And so even with those kinds of growth rates, fast growth rates, well above average growth rates, even through 2021, you don't get to the previous peak in economic growth, which is fourth quarter GDP was the peak in GDP growth. You don't get back to there until perhaps the end of 2021. So I say V-shaped because we're going to see some quarters of what normally would be very fast economic growth, but you don't get back to the previous peak until late 2021. So that's how I define V.
Okay. We've been told that we're nearing the end of the time, so we're going to forward the rest of the questions on to Ken that he can answer, and an email is going to be sent to all the attendees within 2 days of the full webinar, and those questions can be answered in that email. Thank you, Ken.
Okay, glad to be with you.
So Ken, again, want to thank you. I always find your presentations not only informational, but very entertaining in the way that you present and show economic trends. So I want to thank you for that. I hope everybody else enjoyed the presentation, found it useful. Remember, charts will be updated and on the ICI website first Friday of every month. And so that'll be somewhere around June 5th for the next update of the charts.
Can I add one comment?
Sure can.
I've already worked on my cover email that's going to go out with the May unemployment report that comes out June 5th and then distributed to you all. It's going to be a blockbuster. Strap yourselves in. So if I can throw out there a little tease, it may be, in fact, controversial, but stay tuned.
Thank you, Ken. And just want to remind everybody, our next keynote webinar will be Joseph Martin's Keeping Up on Your Mojo in a Crisis, and that will begin on May 28th. So hope to see everybody then, and be safe. Have a good week.